What is a margin account for hedging with futures? Imagine you're trying to protect your investment from sudden price swings. You might use futures contracts to do this. But how do you actually get started with these contracts? That's where a margin account comes into play. Think of a margin account as a special trading account that holds the money you need to buy or sell futures contracts. When you open a futures position to hedge your commodity risk, you don't pay the full price upfront. Instead, you deposit a certain amount of money called margin. This acts as a security deposit to show you're serious and to cover potential losses. The initial margin is the first deposit you make when opening a futures position. It is usually a small percentage of the total contract value, often between 3 and 12%. For example, if a futures contract for 1,000 bushels of wheat is worth $50,000, the initial margin might be around $1,500. This deposit helps ensure you can meet your financial obligations if prices move against you. Once your position is open, your account must stay above a minimum balance called the maintenance margin. If the market moves unfavorably and your account balance drops below this level, you'll get a margin call. That means you need to deposit more money to bring your account back up to the initial margin level. If you don't, your broker can close out your position to limit losses. Margin calls can happen during trading hours or after, depending on how volatile the market is. Using a margin account gives you leverage, which means you can control a large amount of a commodity with a relatively small amount of money. This can boost your gains but also increases your risk of losses. That's why managing your margin and understanding how price changes affect your account is so important. For example, a farmer might sell wheat futures contracts to lock in a price before harvest. The farmer deposits the initial margin into the margin account and monitors the position daily. If wheat prices fall, the account balance might decrease, prompting a margin call. The farmer then deposits more funds to keep the hedge active until they sell the physical wheat. In short, a margin account for hedging with futures is a key tool that allows investors to enter and maintain futures contracts efficiently. It provides the financial backing needed to manage price risks while using leverage. Proper management of margin requirements helps ensure the hedge remains effective and reduces the chance of losing the position prematurely.